Hi, it's Lindsay Labonte, branch manager at Applied Mortgage, here with the Applied Mortgage Community Show. I have attorney Nick Grimaldi with us this morning, and it is such an important time to have one of our greatest attorney contacts here with us today to help us navigate this really intense market that we're in for both buyers and sellers. So really excited to have you here today, Nick. Do you want to just introduce yourself and your firm, just briefly, kind of what your background has been?
Yeah, sure, Lindsay. Thanks for giving me the opportunity to, speak to people about some of the questions they might have from the legal side when they're going through this process. So my name's Nick Grimaldi. I'm a partner at Fierce Bloomberg Ohm in Northampton on Gothic Street downtown. And my practice involves commercial and residential real estate transactions, as well as, other transactional matters, corporate and business transactions. Over the last year and a half, the residential real estate practice has taken up a lot of time. So it's a significant part of what we do.
Definitely. So right now is a seller's market. We've been in a seller's market actually since 2012. Some people don't realize that, but it means it's very competitive now more than ever coming through this pandemic for buyers and also for sellers who are navigating multiple offer situations, talking about their different contingencies and protections they have on both sides as a buyer or a seller. And I threw a list at Nick of probably about 30 questions that I receive all the time in this area. Mostly we're working in Western Massachusetts. It's customary that a buyer and seller might review an initial offer to purchase with their real estate partners, their real estate agents, and maybe not an attorney until later on in the process when they get to the purchase and sale. So there's a lot that goes into negotiating that initial offer. And we're going to ask Nick a few key questions, as much as we can cover today, just to get some general legal advice. And again, this isn't specific to your transaction, so make sure you consult your attorney, but this is definitely going to provide us with some great education, and I'm so excited. So to start off with, usually when someone's making an offer on a house, they're focusing on the price. And right now we're seeing houses go for above asking a lot of times. We're seeing people use escalation clauses. Could you tell us a little bit about what that means and how the people can protect themselves if they're using an escalation clause?
Sure. So escalation clauses we almost never saw them prior to maybe, 12 to 18 months ago. They would occasionally, it would come up, but very, very rarely. An escalation clause is a provision in your offer. By the way, the offer document that you'll sign with your agent will often say contract to purchase on top. And we call it an offer in the industry, but it is a contract. So there will be a longer contract later, but one of the reasons why thinking about these things is important is that document is not just a, bullet point list of things the parties might agree on later. It has consequences. Okay. So with respect to an escalation clause, what that means is, you're going to offer $250,000 for this house, okay? But if there are competing bona fide offers, and that's an important term that should be included, that are higher than your offer, you will escalate or you will increase your offer automatically to a certain amount over that offer. So, as an example, with $250,000, you might say as a buyer, we really want this house. We would actually pay up to $270,000, but we don't want to offer that. So we will put in our offer that we will go $1,000 higher than the next bona fide offer that comes in within a certain period of time, up to $270,000. Okay. Now, if the seller accepts that, then now you're basically held to that. The offer will automatically increase and be binding on you if the seller accepts it, if they received offers higher than the original offer you made.
And does the seller have to show you those other offers? You mentioned this bona fide offer. How is that
Well,
actually tested?
that's a really good question. It depends on how you write it. Now, I would say that it absolutely, first of all, the term bona fide, means, a real offer, right? Not a hypothetical offer, or, someone that made an offer that says, well, I'd buy it for 260, but has no indication on how they're going to pay for it, if they're going to take a mortgage. That's not a bona fide offer.
Right.
A bona fide offer to me also is not an offer from somebody's brother. I mean, we don't see a lot of people playing fast and loose with this, but just so people understand, what we don't want is a seller to see that and then have their uncle make an offer.
Right.
Right. That's not a bona fide offer. It's not an arm's length offer. So I think it only is logical that you would have to show proof that there was a bona fide offer. Yeah. However, I would suggest, because people's sellers' agents are different and sellers' attorneys are different, and I think you really ought to write that in, that written proof of the bona fide offer shall be shown to the buyer in order for this clause to be effective. The other thing is, I said before that you would put in that, and I probably made an assumption, right, that it would be up to a certain amount, right, up to 270,000. Well, I've seen them where that kind of didn't get put in, right? So buyer will pay $1,000 higher than the next bona fide offer. Well,
right,
that's okay, but you're running a risk.
There's no end in sight.
That's right.
Yeah, interesting. These are all great points. Yeah, and so when you're drafting up this offer, this contract, as Nick said, it's really important to know that these are real agreements that you're putting in writing. And there are so many kind of typical items that you'll go through. You'll go through the price, you'll go through your home inspection contingency, your mortgage contingency, the property has to have clear title, kind of all of these things. So these are some key points that we're definitely touching on here. So I'm curious about the mortgage commitment contingency, which many people will have if they need to buy the house with a mortgage. And people ask me a few different questions in relation to that. Is my appraisal included in that mortgage contingency? Is my home inspection included in that? So if they're including their home or their mortgage contingency, what is that actually protecting them with? Right.
Well, in the mortgage contingency, certainly we see cash buyers, and of course, folks watching this podcast probably, aren't in that category, right? So I mean, but for the vast bulk of people, the mortgage contingency really is the most important thing to include, and it's very typical. The offer documents, the contract to purchase, there's standard language in there that kind of governs some of these key contingencies. They aren't written from scratch by the agents, and they're fine. The language that's in there is appropriate usually. Okay. But what does a mortgage contingency do? Well, what it says is, look, as a buyer, I'm going to offer you X amount of dollars for your house, and if you accept, one of the conditions, we say contingency, but let's call it a condition, is, I have the ability to apply for a mortgage at a certain either amount or percentage of the price. And if I don't get that mortgage, if it's denied, or I don't get the mortgage on the terms that I applied for, and this is my pet peeve. That to me is an important issue. It's not just getting the mortgage; it's getting the mortgage on terms that aren't different than what you expected to get when you applied. And we can talk about that more if you'd like to. But and there's always a date, and that date's typically it varies. But let's say it's typically a month or so, give or take, maybe a month to 45 days after the offer. Okay. So how does that protect the buyer? Well, the idea is, look, I'm going to apply for a mortgage. I have to do my best to get the mortgage, give the lender everything that they ask for. But if, either because of my finances or otherwise, the lender either denies a loan or can't give me the loan in the amount that I need, then I have the ability to get out of the transaction. Now, nobody wants to get out of the transaction, but if they were denied, they would need to invoke that contingency because they put down money that's on deposit. And if they didn't get out of the deal and they couldn't close, which they probably couldn't if they didn't get the mortgage, then they would lose their deposit. So a lot of what we do is about trying to make sure we protect the buyer's deposit until closing, so that they can get out if something happens, like not getting a mortgage. Okay, can't protect them for everything that could happen, but okay. So that's why we pay close attention to that date. The date is super important, and your agent, real estate agent, and us and our partners, at Harbor One or whatever lender have to keep a close eye on that date. Okay. Now, part of what, well, I mean, you can speak more to this, Lindsay, but part of what happens during that period of time between signing the contract and getting to that date is the lender is doing an appraisal, almost always, not always, but almost always. And that's a valuation of the property, because the lender wants to make sure that they're lending money on property that supports that value, right? So I guess the question that you asked, one of the questions you asked was, well, does the mortgage contingency that's standard include the idea that the appraisal, the value of the house, must equal the purchase price of the house?
Right.
And the answer in Hampshire County is no. Okay. The answer in Hampshire County is no. And that's primarily because sellers, in looking to put together an agreement, standard form contract which we've done, that buyers and sellers, lawyers both can agree on, right, without fighting over terms each time there's a transaction. That's a provision that sellers, lawyers say, hey, wait a minute, if you want that, then you negotiate it at the time. Otherwise, it's not part of the deal. So let's unpack that a little bit if we can. And this is where, I do this all the time, so it's easy for me to understand this, but it might be a little hard to understand. If you're a buyer that's applying for, let's say, an 80% standard mortgage, right, which is pretty typical, right? You're going to borrow 80% of the purchase price, okay, in a conventional program, okay, loan program, or you're borrowing a higher percentage, okay. Typically, if the property does not appraise at the purchase price, and by the way, Lindsay, correct me if I'm wrong, because it's very possible that I'm wrong, but I don't think I am.
So far, so good. I see where you're going.
If the property doesn't appraise at the purchase price, you will not get approved for the loan in the amount that you borrowed at the terms that you applied for. Either there'll be an interest rate adjustment, or there'll be points, or something called private mortgage insurance could apply, which is totally a fine thing. But if you're not expecting it, then it's a different term, right? So at some level, even without a provision that says appraisals are a condition, or appraised value is a condition, it's already baked in. Because if you're taking out that kind of loan and it doesn't appraise, is the term we use, at the full price, well, then they're going to get a letter or an email that's going to say, hey, it appraised at $10,000 less than the purchase price. That means we have to slightly reduce your loan amount unless we change the terms. In which case, I would view that as, well, the mortgage contingency isn't satisfied. And sometimes that leads to additional negotiation between the parties. Typically, people don't back out on that basis of the deal, right. But it'll be additional negotiation about, gee, maybe you can reduce the price, maybe we'll come up a little bit and meet in the middle. The seller doesn't have to do anything, but they can say no, and you can either get out of the deal or you can proceed. But it usually allows the buyer to have some rights. Mm-hmm. Where it's an issue, and where if you're concerned about it, you should definitely put it in the offer that it's subject to appraisal, is if you're borrowing less than 80%. And this does happen, right? Somebody wants to get a mortgage loan. They even need a mortgage loan, but they're going to basically borrow 60% or 50% or 65%. So why is that different? Well, the reason is, from the lender's point of view, they'll lend you 65 to 50 to 70% typically, whether or not the property appraises at the exact amount you agreed, right? So again, using the example of 250, if the property comes in at a valuation of 235 and you're only borrowing 50% of $125,000, the lenders will typically give you the amount that you wanted, 125, okay? But, if you're concerned that you are overpaying in that sense, because you're going to end up paying a full 125 extra above the loan, even though the appraisal said it was worth less than that, then you need to make sure that's a condition in your offer. And some sellers will agree, some sellers won't. It depends on the market, we're in. And right now it's not super favorable to negotiate something like that, but you can ask for it.
Right. Right. And that's why all of this is coming up so often, because really sellers do have a little bit of the advantage with such scarce inventory and more buyers and more offers to view. So instead of just looking at an offer and taking it face value, how much money is the person offering, and maybe looking at their closing time frame or the typical items, we're really getting into more of the weeds on all the rest of these details here. So Nick, you just made some awesome points, and I want to just back up and kind of bullet point a couple of things before I ask you another follow-up question. So why these items are so important is because a buyer is giving seller a down payment deposit. You're giving money to bind this contract, and you want that money to be protected. So whether it's, typically we see maybe $500 or $1,000 at the initial offer, and then maybe a full 5% of the price of the house given with the purchase and sale. And that's all before you actually close and own the home. So you want to make sure that all of these conditions or contingencies or provisions, as we call them, make sense and are protecting that deposit money. I think it's a really great point, and I haven't heard it explained this way, that the mortgage commitment date and condition is really protecting the buyer to make sure that they are able to get the mortgage for the terms they said they were going to get. I think that's a really clear and important message for everybody to understand. So you had alluded to this a little bit, but I get this question frequently. Let's say that a buyer has cash to put down. They can do 25% down, but they don't really want to. They want to do 10% down because they want to save the rest of the money for maybe renovations after. They know their offer is going to look stronger if they say they're doing 25% down, and then they just want to change it after to only 10% down. So in that situation, what's the risk there?
Well, this is really a great question, and we see this a lot. And I try to explain it like this. The first thing to understand is that the mortgage contingency amount that's an amount that's there to protect the buyer. It's not for the seller's benefit. So people will often say, I said in the contract that I would get a mortgage by X date. And, the seller's agent's asking questions, well, the seller can't require you get any mortgage. I mean, it's a contingency for the buyer. And nor can they require you get a mortgage in any particular amount. So my point is, if the mortgage contingency says 80% of the purchase price and the purchase price is $200,000, okay, you are protected in the contingency if you apply for a mortgage of up to $160,000, okay. And again, from the seller's point of view, the lower the mortgage amount, the less risk there is that you won't get it. I mean, I don't know if that's actually true, but in a way it is, right? So sellers always would like to see a lower percentage of mortgage in general. And, buyers are looking, I think in most cases, to just put down what they think they're going to apply for, right? And so if that means that with a $160,000 mortgage contingency amount, if you're a buyer, if you've applied to any mortgage amount up to 160, then you are protected under that contingency, okay? Protected meaning if you don't get it, and as long as we abide by the date, okay, or extend the date as needed, if you didn't get it, you would be able to get out of the deal and get your deposit back, right? Again, that's what we're trying to make sure we do as much as we can in the agreement is protect the right to get the deposit back. So the question is, well, what if we do that because we don't want to write down that we're going to apply for a mortgage at 90%, even though we can get it, okay? What if we apply for more than what it said in the agreement? Well, there's two answers. The first answer is you can do that. It's not you haven't violated the agreement. You could apply for 150% financing if you can get it, okay? The risk, though, is that if you do that and you are denied the mortgage, the seller's lawyer is going to say, okay, we'll process, I guess you got to get out of the deal. We'll have the broker process the refund. Why don't you shoot over that denial letter so we just have it, proof that there was actually a denial. And it says loan amount that is higher than what was in the purchase and sale agreement. You have a problem, potentially a problem I wouldn't want my clients to have, which is you have to say, well, yeah, but they applied for more and because they could have gotten it. And look, they would have been denied even if they had applied at 80%. Well, now you're in an argument about your deposit, or you're doing a lot of work to try to get your deposit back. I don't like that. It's too risky. And so what I typically tell people is that's at your own risk. I mean, my suggestion would be, and your underwriters aren't going to like this, or your processors aren't going to like this, Lindsay, but look, get the loan approved at the amount that's in the agreement.
Right.
Typically, unless you're really cutting it tight with time, it would be possible at that point, if you can qualify for more, and I may be, again, correct me if I'm wrong, Lindsay, but it would be possible to borrow more. But now you at least know you have the approval at the amount that you could buy the house with. Okay.
Yeah.
And now it's just a matter of, well, maybe we'll borrow a little more before closing if we can get it, but we're okay. And that way you can let the mortgage contingency be satisfied and then pursue additional amounts, if that makes any sense.
Yeah, that definitely makes sense. And as far as protecting the down payment deposit here, we're not necessarily talking about a small amount of money. If the average sale price in Hampshire County is $370 and you're putting 5% as a good faith deposit, I mean, that's $18,500. So you don't want to mess around, like Nick's saying, with what you're writing in to say that you're gonna do. So this is all really, really rich information here. This is awesome. I have a couple of more conditions, as we're calling them, contingencies, that I want to just wrap up with here. And we're definitely a little over our normal time, but I just think this is so valuable that if it's fine with you, Nick, I'm going to ask them anyway.
Absolutely.
So one question I'm getting all the time is about waiving the home inspection or saying that it's for informational purposes only. That's the question I have more. I mean, waiving it sounds pretty clear. You're not having one, no protection there. Maybe I'm wrong, but what's the for informational purposes only? Can you still back out?
Right. So this is really timely. And I think I said I had a sort of a pet peeve earlier. Well, I have another pet peeve. That language is not, that language is popular. I understand why. It is not good enough, in my view. And when I'm, even if I see it, when I'm trying to work up a longer contract with the other lawyer, I put in more extensive language than that, and usually it's accepted. But really, the agent should be writing it like this, and I hate to tell them how to do it, but what it really means is, we're not going to ask the seller for nitpicky repairs, and nitpicky is an eye of the beholder, but we want to do the inspection to either, number one, know what things might have to be fixed down the road, or two, to rule out any major concerns that would actually cause us to back out of the transaction. And that's what informational purposes means, but not to then make a laundry list of, repairs of outlets and, things that might amount to a couple $1,000s that we want the seller to do. So typically that language is interpreted to include the idea that If you're not satisfied, you can still get out of the transaction and get your deposit back. By the way, at that point, most commonly, you still only have a $500 or $1,000 deposit. That is, you haven't yet gotten to the point where you've put down the full 5%, although sometimes you have, okay? So the idea is you can get your deposit back if you're going to back out of the deal, but please don't come to us for repairs. I think, it should actually spell that out in the offer. It should say, inspections, buyer acknowledges that their inspections are for informational purposes only. They will not request repairs or concessions, but the buyer retains the right to terminate the contract if unsatisfied with the inspection, as long as notice of dissatisfaction is provided by the date that it says in the contingency.
Right.
Obviously that sounds like a lawyer's talking, and it is, but that's what it should say. If it doesn't say that, there's always the potential that there'll be some misunderstanding about what that means.
Yeah. And I think that's a clear message with all of these, right? It's that this is a contract that's going to be interpreted by other parties. And so having clearly written statements is super important, whether it's in regards to the purchase price and the escalation clause we spoke about, the appraisal and any, appraisal differences, your home inspection period, the mortgage commitment, and the terms of your mortgage. And I'm going to see if you can do this in like under 2 minutes, but one other contingency, I guess, on both sides. And now I'm seeing this less frequently again because it's so competitive, but people still ask the question. When a buyer has a contingency to sell a home in order to buy a new house, or sellers are saying, well, I want to sell, but I don't have anywhere to go. What about a contingency for the seller to find suitable housing? So maybe an overview on.
Let's do that real quick, Lindsay. And I do think we should talk about the appraisal gap language before we wrap up, okay?
Yeah, let's
talk quickly about the sale and purchase contingency, because that can be done quickly. So bottom line, we're not seeing much with buyers having any leverage at all right now if they make an offer that says, well, my offer is subject to me finding a seller, a buyer for my house in New York State. Although it does happen. And sometimes people are basically making an offer, not putting it in because they don't want to scare off their seller in their new home, but they still know they have to sell their house, and they're hoping because the market's strong, they'll do it in time. Well, you can do that, but there's a risk. If you don't sell it, or for something, your sale falls through, if you're a buyer on your other house, you will have to perform, or you will lose your deposit on your purchase. Now, looking at the other side of it, what if you put an offer on a house where the seller says they need to find replacement housing? Well, again, we see that a fair amount now, and it's fine. But the thing that buyers need to keep in mind is trying to, with their agent, provide some structure around that, meaning some date, some procedure by which they need to keep us, the buyer, informed on what their progress is, because otherwise it can go on indefinitely. If the seller has the ability to say, well, you agreed to something that said I had the right to find suitable housing. Well, even though it's now the closing date has passed, I can still keep you hung up on this deal, on this transaction, for another month, another 2 months, unless you've written into your offer some parameters around that. And I strongly suggest that people think about that and put a time limit on it.
Definitely, yeah.
Do you want to introduce the idea of the appraisal gap, or do you want?
Yeah, let's do that. Let's do that. I said I had a list of about 30 things, so we're going for all of them. So yeah, let's jump back to that appraisal, because that's a big question now. So you talked about what happens if the appraisal comes in different than the purchase price, but another question we're getting is writing in an appraisal gap. So somebody will ask me, as a lender's perspective, if I were to offer $250, but say I would cover any difference in the appraisal up to $25,000, what happens? So,
well, again, this is really big right now. We see it a lot, and I don't like it, but people have to go into it with open eyes, right? So what it means exactly what you just described, right? So we talked about the idea that lenders will lend up to a percentage, usually 80% on a conventional type program, of the value. So let's say you applied for an 80% conventional type loan. And, it's the price is 200, just to use, an example. And the appraisal doesn't come back at 200, it comes back at 180. Well, the lender's not gonna loan you 160 at the terms and rates you applied for. There's gonna be other terms if they're gonna give you that amount. So really what you would get is 80% of 180. And it's too early and I haven't had enough coffee to do that math, but it's less, right? So you might be in a situation as a buyer where you're like, look, I don't actually have that money, right, to make up the difference. The amount I was gonna put in was 20%, that's what I've got. So people are basically, though, entering into agreements where they say, well, seller, please don't worry. If there's a difference between the purchase price and the appraised price, we'll make that up, right? Even if our lender will only give us not 160, but 150, we'll make up that extra 10,000. As long as you understand that's what that means, go for it, okay? But that's what that means. And here's another really important point, and please do this. Please do this. Please put a limit on the amount of gap you're willing to make up. And I see it a lot without any. Now, look, if people have unlimited funds, then great, okay? But I'm not sure that that's always understood. And the offers are maybe being rushed into. It should, because if there is no limit, theoretically, the appraisal could come back at half it doesn't happen, but half the purchase price. Yeah. And you would literally be bound to come up with the rest of the money, which of course nobody would.
Right.
And you would lose your deposit. You would absolutely lose the deposit. It's a breach of you would have broken the contract.
Right.
So put a limit, whether it's, up to a gap of 10,000, up to a gap of 20,000, up to a gap of 5,000, and if the seller won't accept that, maybe it's not the right transaction for you. My agent partners will kill me for saying that, but you really have to be willing to put that money into the deal to get that house.
Yeah. Awesome. That's so good to know. And I think we were maybe speaking about this when we were offline before, but in our area, you said it perfectly. I mean, we're not really seeing agents that are wheeling and dealing and intentionally getting any customers into situations that they shouldn't be in at all. So everything that you're saying, and in speaking to other agent partners that we work with, I know everyone's working toward doing in good faith, and the just abundance of offers that are sometimes on one property. Sometimes buyers are asking to have these contingencies totally waived or just written in really vaguely because they want to end up at the top of the pile. But what you're saying, everything's so important to understand whatever's in writing, know how it's going to be interpreted, make sure the details are really clear, and make sure that you can actually do what you say that you're going to do so that you don't lose that deposit or get into a situation where all of a sudden you have to buy the house cash or something, and that wasn't the intention. So this is awesome. Any closing thoughts? I mean, for sure, our realtor partners who we're working with, our home buyers we're working with are going to want to know your contact information at the very least, because this is so awesome. What can you leave us with here?
Well, I mean, I guess what I'd say is, to sum up, is exactly what you said, right? So the agents that I work with regularly, and I think they're professionals. They're really good at what they do. They are experienced, and everybody's working toward the same goal here, right? We're all part of the team. Once there's a team assembled, we're working together, not against each other. I see things as a lawyer, a little bit differently, because I'm not dealing with the back and forth and the fast moving pace of these offers. So when I say I'd like to see something written like this or like that, so it's not a completely practical always that comes out exactly the way I'd want it in the offer. And that's just the nature of the way it works. But ultimately, the main thing is to be familiar with these ideas, so that when you're signing off on something, you either ask the question or you understand what it is that it says and what it doesn't say. Okay. As far as my contact information, Fierce Bloomberg Home is listed on the banner there in Northampton, and we have a website. And if anybody wanted to connect with me with general questions about their transaction, I generally am happy to talk to people thinking about looking for a lawyer. There's no obligation, obviously. until they decide. And people should really pick a lawyer that they feel they have a good connection with. I mean, there's those of us that do this work. There's a lot of good ones around in the area, and you just want to find one that you connect with and work with well. And so I always encourage people to call more than one, really.
And I can definitely attest that Nick and the whole team at Attorney Bloomberg's office are excellent. They roll up their sleeves. They're real people. As you can see, sometimes thinking about an attorney seems scarier than even thinking about a lender, right? We're not in suits over here. We're real people. So thanks so much for being with us today. Really appreciate all of your expertise. And we'll probably have more questions to do a follow-up at some point in the future.
I would love it. I mean, as you could probably tell, I could have probably continued to talk for another half an hour, but I'm glad you reined it in.
It's all valuable. Thanks so much for being here.
Take care, Lindsay. Thank you.
That's a wrap. Thanks so much for tuning in to our Applied Mortgage Community Show. As always, if you have any mortgage-related questions, please contact our team at Applied Mortgage, 413-586-5626, or appliedmortgageteam.com. And if you want to be featured on one of our episodes, let me know. We'd love to have you.